Country Direct, redefining insurance.
All right, oil prices continuing to tumble. You talk about something that is well into bear market territory here. What happens? What does this mean? Cheaper gas prices, one thing. This, of course, buffets a lot of the energy components that dominate the Dow and those that dominate the S&P 500, and they're taking it on the chin here. But the flip side of that is it does ignite consumer buying activity or eases the blow for consumers who otherwise are looking still at an iffy kind of recovery for them. So let's get to read from the Schork Report founder and editor, Stephen Schork. Is this overdone, Stephen? What do you tell clients when they look at these prices?
Right now, what we've been telling clients all along is that oil prices now are in the extreme danger zone. That is to say that even at your lowest cost producing margins, anything below $50 is now going to cause a heartache going into not necessarily the first 6 months of this year, Neil, because you've had oil that was well over $70 a barrel for most of this summer. So you have a lot of forward production, and that has been hedged. We have oil producers that will be making $70 a barrel. Based on their hedges. But we've had a significant runoff now, 40% off of the highs. I think those highs that we saw in September was all based on hype. It was a speculative bubble. We were all talking about the implementation or the reinstatement of sanctions on Iran. But that was 6-month-old news. So we've certainly popped that bubble, but now we have overdone it. And so what we've had now, Neil, is, and the concern here is that, yes, lower oil prices will translate into lower gasoline prices. So people will think that's a good thing. It, in certain respects, it is. But let's keep in mind that commodity prices do not drive economic growth. Commodity prices are a function of economic growth. So a 40% decline in oil prices, a 25% decline in industrial metal prices over the last couple of months does not bode well when we look at the economy going ahead in 2019. So yes, enjoy these low gasoline prices, but it could certainly mean that we're looking at economic stagnation going into the new year.
But have we ever reached a point at which the gas prices alone ignite consumer activity and start reversing the trend we see going on now? Is there an inflection point?
Well, there is an inflection point on the high side. That is to say that we do know that gasoline is no longer the perfectly inelastic demand that we've always seen, because we do have substitutes now in the market. And that's an excellent question because, I myself in the Schork household, we have a plug-in hybrid. I fill my SUV up once every 6 weeks as opposed to 2008 where I was filling it up once every 6 days. So my demand patterns have certainly changed, and the market's demand patterns have certainly changed. So I'm not a big believer that gasoline prices or low commodity prices can turn the market around. I do think that's putting the cart in front of the horse. And we've had this discussion, in general in the report, going back when the market originally crashed in 2015. Everyone thought sub $2 gasoline at the pump was great for 2015. But do we remember what the economy was like in 2015? So I really don't want to go back to those days. But with the oil prices and gasoline prices where they are, plus where aluminum prices are, iron ore prices, so forth, it is certainly a bit of concern going ahead. Obviously, we had the inversion or in certain maturities along the yield curve. We have the ongoing rift between Beijing and Washington with the trade trade tariffs. Right. And therefore, there's a lot of question marks and a lot of volatility going into this new year.
Yeah, and if in doubt, you just sell out. That's what's going on right now. Stephen, thank you very, very much.
Yeah, I think so.
All right. Thank you, my friend. All right. Is anyone taking credit for the sell-off as much as we did for the volatility and the run-up that was really precipitated on the same developments? I want you to hear from the Treasury Secretary talking to Stu.
Completely. I think that with the advent of computerized trading, which has such a big part of the market now, combined with the Volcker rule, where you can't have market makers commit capital, you just have much bigger moves in both directions. And I think clearly you have a situation here where the market has overreacted to the Fed's comments, and you see program trading taking over.
All right, that made little sense to me if you think about it, because the same factors were in play when we were running up, right? So you didn't mind them when we were running up, but now you have a big problem when the things are going down. God forbid anyone anywhere should take responsibility for anything. It just doesn't happen. All right, Charlie Gasparino, what do you make of that? I thought it was a kind of an interesting excuse, but I mean, blame it on volatile, fast, rapid trading and all of that. But
He's not totally wrong. Obviously, swings because of algorithms they kick in. By the way, that price discovery right now is so fast because.
Right.
You know, a moment something
factors were up
happens.
when we were running up, though, is all
In the
I'm
old
saying.
days, when everybody used to call each other and go to the New York Stock Exchange and get a market maker to buy your stock, things happen slower. This is instantaneous. You have instantaneous price discovery. That's
But
not
it was
always
instantaneous going up, is what I'm saying.
Great point.
Yeah.
And what your first guess was really good. The guy from
Steve Schork, yeah.
from the oil report, he made a great point that